After computing national income, you might think that there is nothing else to do, that national income should equal GDP. That's because we naturally think that every dollar spent is someone's income. But when we check the actual figures for national income and GDP, we find that they are not equal. In other words, not every dollar spent is someone else's income. For example, if Rahul spends $10 to buy a book, $9.50 of the $10 might end up in the seller's pocket as income, but 50 cents of the $10 might go for taxes. With this in mind, the income approach to computing GDP requires us to add certain things to national income and to subtract certain things from national income. The following equation and exhibit shows what must be added to and subtracted from national income to compute GDP. GDP is equal to national income minus income earned from the rest of the world plus income earned by the rest of the world plus indirect business taxes plus capital consumption allowance plus statistical discrepancy. Let us first see income earned from the rest of the world. Consider that when we compute national income, we include the income earned by our island citizens who work and live in other islands. But we do not include the income earned by foreigners who work and live in our island. But if we want to compute GDP, we have to adjust for both these incomes. We do so by subtracting from national income the income earned from the rest of the world. This is the income earned by our citizens by producing and selling goods in abroad. And 2. By adding to national income the income earned by the rest of the world. This is the income earned by foreigners by producing and selling goods in our island. We have talked about direct taxes of individuals and household as income to households only, and hence we have not deducted from the salaries and profits. Now let us look at indirect business taxes. The main items that comprise indirect business taxes are excise taxes, sales taxes, and property taxes. These taxes are not part of national income because they are not considered a payment to any resource, land, labor, etc. You should think of them as money collected by government and not as payment to land, labor, capital, or entrepreneurship. These indirect taxes are included in purchases of goods and services. You pay a sales tax when you buy most goods, and so are included when the expenditure approach is used to compute GDP. Therefore, we must add indirect business taxes to national income. Capital consumption allowance. Some capital goods are used up in the production process through natural wear, obsolescence or accidental destruction. Example, the machinery that breaks down and cannot be repaired. The cost to replace these capital goods is called the capital consumption allowance or depreciation. We add the capital consumption allowance or depreciation to national income because we want a measure of all the income earned in the economy. National income by itself does not include the income payments implicit in the capital consumption allowance. Statistical discrepancy. GDP and national income are computed using different sets of data. Hence, statistical discrepancies or pure computational errors often occur and must be accounted for in the national income accounts.